Students, we start with lecture 3 to understand the limitations of traditional cost management. One could ask the question that what is traditional and what is modern in cost management? The term cost management are same in both the case of traditional and modern, but the perception behind cost management, the focus under the cost management in the traditional concepts, one may say in the 20th century, more or less till the end of the 20th century, was different from the focus of cost management in contemporary business houses, in modern business houses. That is why it is essential to make a difference between the traditional cost management and the modern cost management. Quite obviously, if the modern cost management differs functionally opposite to what was traditional cost management, then there must have been some limitations to the traditional cost management. So let us look into those limitations for understanding better the reasons why a modern cost management emerged. And throughout my lectures in other topics, I shall bring out to you the benefits that the modern concepts of cost management is bringing to many business houses. Not only outside India, but within India, there are more than 250, 300 companies, big-sized companies, small-sized companies, government departments, which have extensively used the modern concepts of cost management and has benefited tremendously out of it. But let's first concentrate on understanding the traditional cost management. I'm sure when you did your cost accounting at your inter level, you must have surmised many times that you did these things more as a matter of rule prescribed to you rather than really going by the rationality of a particular concept. In fact, this is the basics of an accounting system. The traditional cost management system is basically an accounting focused mechanism. It tries to find out what is the value of raw materials, what is the value of inventory use, what is the value of production, what is the cost of material consumed, what is the cost of goods at the factory cost, what is the cost of work in progress, what is the cost of sales, etc. And it is expressed in the accounting system. So when I am talking about an accounting system, obviously I necessarily mean the financial accounting system. Right. Now the accounting includes, in this process of cost accounting, which formed the hub of the traditional cost management, that accounting includes the allocation of factory overheads to products, which is based on factors like the volume of consumed production resources or the volume of the output coming out of those consumption of those resources. Okay. In the accounting concept, what happened? You go by the expenses incurred. They were treated synonymous with cost. Now, the cost was distributed. The reason for distribution came because the same processes, same expenses incurred were benefiting more than one product. Since the focus was to find out the cost of the outputs, so these expenses which were incurred in common for more than one product, they need to be distributed to identify individual product costs. All right, you understand? Now, this factory overheads, visualize in a factory, there are 5 different products are coming. Like say Maruti, 5 different models of cars are being manufactured. Now, what you do, this factory overhead is distribute among the cost of individual motor car processed in a factory floor. How do you distribute it? Either you distribute on the volume of the resources consumed, so much of material, so much of direct labor, all right, so much of electricity consumed, all right. Or if you cannot do that, do some parameters of the output, maybe length of the car, maybe the HP of the car, okay, maybe even the market value of the car, right? Any time. But the main point is, the focal point is distributing these common expenses on some basis, either relating to the resources consumed or relating to the output coming out. Right. Now, reflect for a second that there is an expense incurred which is neither linked to the resources consumed nor linked to any parameter of the output coming out. Okay. Let us say, for example, there is a quality inspection is being done. Now, how does the quality inspection is done? Some quality parameters with instrument, without instrument, human judgment, he goes and tests. Suppose that quality is done halfway through the production flow. Say, for example, the the steel is being processed. So, what are you judging the quality? The judging the quality is processing of that steel. Now, the processing of steel is required whether it is one car or 100 cars. And the steel actually that is going to a particular car may be different. Right. So, this quality of the cars for processing the steel in the production flow, as an example, may not be related to the volume of the resources consumed. Obviously, not related to any parameter of the outputs. All right. Let us take another example. Say, for example, the income of the customers group as a group is falling down. Or take the latest Indian case that automobile industry is losing its demand. Why it is losing its demand? Because there is no demand. Why there is no demand? There is a less money in the hands of the potential buyers. Now, if because it is less money in the potential buyers, you give them loan, okay, through some process. And then when you give loan, you incur expense, okay, some opportunity cost. Now, how will you distribute this cost with regard to your manufacturing process? You understand? So these aspects do not come within the parameters of the traditional accounting system. Companies which were using this method, and there are many companies in India which are still using this method, will apply overhead with either the number of machine hours used, or the direct labor hours which were consumed, or the number of units produced. Overhead rates are applied on the basis of cost drivers, reflecting what is required to produce finished products. Now, this aspect, the cost drivers, that I am interested in the final product to come out, and therefore whatever the cost I am incurring is directly reflected to the final product, may not be necessarily true in the modern concept of business. Any systematic costing method that was used before the advent of activity-based costing, that is in 1990s or even till end of 90s, is classified as a traditional costing system only. Mind you, this traditional costing system is still being used in many of the companies. Traditional costing system is best used when an organization has a low overhead cost compared to the direct production cost they incur. This was the traditional concept why overhead cost was recognized and appropriation methods were evolved and all. And they were successful then. When volumes are large, that is when you get into a global market, and overhead costs don't create a significant difference when calculating product cost, then it proves an accurate figure that can be added as a relate to a finished product or services, right? Because even if you make a mistake in allocation, it can be a mistake of 5% this side left and rest or 5% more. It won't affect your product cost. The problem comes when overhead cost is predominant. Like let's take for example service sector. Now service sector is one where overhead concept is challenged completely. There are no fancy calculations or forms required to determine the average overhead. There is no prescribed, there is no calculation, there is no method. It's purely managerial discretion choice. All you must do is to calculate the amount of time it takes to produce a specific product or provide a unique service and divide by that time all the overheads. Then you take the average rate of labor, machine use cost per hour, multiplying it by the length time necessary to create sellable goods. This is the simple principle of overhead rate. Howsoever complicated it might have appeared to you when you are doing overhead absorption cases or process accounts or job order costing, nothing. All these comes down to simple logic. You find out some method and distribute them. And even if you compare it as a variance, unabsorbed overhead or overhead absorbed overhead, you find out a managerial method of accounting system and either decrease your profit or increase your profit to keep a consistency in reporting. Fine. From financial reporting point of view, this seems consistency is very good objective. But this won't help you in carrying on your business in a progressive manner, in a growthful manner. It creates reports which are easier to understand because it's an accounting base, a logical base, debit and credit. You can easily understand it, and it is still able to track all direct costs. Right? That's what I said. If direct costs are predominant in any product, then fine. The traditional accounting costing system is good. It enables to streamline the accounting process and control through the same accounting process as used for financial reporting purposes. You know what is the value of the WIP, what is the value of the finished goods, what is the value of the inventory, what is the value of unused inventory, and you can make a lot of innovation within these overhead costers and make reports out of it and be quite convinced that your costing system, accounting system is perfect. But there are limitations. If you want to summarize all the limitations to understand, it means this. Modern businesses do not depend upon volume of the product that you are manufacturing or volume of the products that you are selling, but along with these two factors, there are many other factors which impinge on the business decisions. And because of that, the traditional cost management system surfaced limitations when there were paradigm shifts in the businesses. One of the very classic points in the traditional cost management, it depended upon the historical data. It gave very less importance to what is happening. Now, technology is something which we have seen, all of us have seen in the last 20, 30 years, which is galloping forward. Changes is in galloping manner. All right. So therefore, if your accounting system was based on technology 1, your accounting data is of no use when the technology has already come to 2. This is the one of the fundamental defects of the traditional cost management, that it doesn't take into account the paradigm shifts, the changes that are taking place in various aspects, including the customer's value, what is perceived by the customer as a satisfying product or the services that he is going to consume. The traditional cost management tends to distort the actual expense, looking at the profitability of products or services by arbitrarily, underline this word, assisting cost for all activities instead of considering the cost of each action required to bring the product to sale. What makes you to perform a particular activity is not considered in the traditional cost. The activities performed. Therefore, the value of those activities must be distributed. Right. Let us say, for example, you are painting your machine. All right. Now, the painting of the machine do not have any relevance to the customer who's buying the products from manufactured from those machines. But in fact, he doesn't know that you are producing. It doesn't affect his value systems. You either paint from red or black or blue. Someone might say, look, this painting helps in keeping the machines in order. All right. Now, the keeping machines in order is absolutely of no meaning for a customer who is interested in getting his product as he likes. Think this issue very carefully and you'll be able to appreciate that unanticipated expenses, therefore, are ignored under the traditional cost accounting system. The traditional costing system does not show enough specifics to identify where waste might be occurring within the system. Right? You consume more of a resource, you consume less of a resources. They're all, of course, addressed under the standard costing system. But remember, the standard costing system also will fail when you consistently doing the waste. You do not know it is a waste. You consistently follow the same practice. Say, let us say, for example, a particular input, raw material, is kept roughly about 100 meters away from the machine. So what in the machine floor it is done? Manually or mechanically, the goods will be traveled for those 100 meters to reach the production. For the traveling, there is a cost involved, handling of the machines, the labor cost, the cost of the machine which carries it. Now, this cost is non-value adding activities. This activity is not adding any value to your profit or to your customer, anything. Unless, of course, you are in seller's market that you can sell anything. But in a global market, it is not. Companies have addressed this and they say cellular manufacturing system. Bring the materials nearest to the production machine so that the time taken to shift from the store or the inventory place to the production machine, producing machine, it's minimal. Now, this will reduce the cost only when you appreciate the fact that this is a waste of time. Right? But if you don't appreciate it, the time spent becomes a part of a standard production time. And therefore, you continue to have a feeling that you have achieved your standards. It does not account for non-manufacturing costs. There are many non-manufacturing costs which are incurred, which are very essential, which we shall see in our example, various types of activities that we perform. Outcome accounting information, that is the output accounting, may be misleading with a disconnect to the business strategy. Right. Your business strategy is not simply because I want to produce 1,000 cars, 1 lakh cars per day. Not only that. That is in fact a goal. That's the end aspect. To achieve that, what are the strategies you require? Now, your cost, if it is not related to the strategy, then your strategy is not being supported by the incurrence of a cost, or the incurrence of cost is of no value as far as the business is concerned. What are the approach you follow in traditional cost management to further invigorate what I have already explained to you? Cost analysis is usually done as a reaction to specific developments. There is suddenly an alternative supplier is available. When you find out costing, what is under the existing supplier, what is the cost. If suppose we go to the new supplier, what will be the cost? Compare them and say, okay, we go by this. Otherwise, you keep quiet, you're satisfied with the supplier. Imagine hundreds of companies and manufacturers and business units in a country like India who are tied up with one single supplier may be suffering heavy costs, may be uncompetitive because they have chosen one single supplier. Look at this aspect. The moment a new supplier comes, they then react to the cost. Right. So in this accounting system to react to an event to happen is contrary to an expectation of a business in a continuously changing environment. It will not be suiting to you. You may be late in reacting to a particular change that has taken place. We shall describe this point thoroughly well when we go to a modern cost management tool known as target costing. Cost data largely focuses to support internal decision environments. There are many external decisions Suppliers don't want to supply every day. He says, I'll supply you only once a week. You have never taken into account that decision of the supplier, how it will impact your cost. Right? Internal activities are the only focus area and they are perceived as distinct functions like manufacturing, etc. All right. No, that's not true. This is supply chain management is a fact of life today in businesses, which traditional cost management doesn't recognize. Cost evolves through the internal perspective about the products produced or provided. What must be product? How many products must be produced? What was the demand last year? How much will be the demand? These are all internal decisions. Okay, can we pay salary to a particular additional quality inspector? Can we reduce a particular aspect to it? In one particular airline, when you go to the airport, there are functionaries who tell you which counter for you to go. Right? They're known as upfront counters flaggers or flyers. They'll just tell you, direct you to it. So an airline's thoughts, so this is an unwarranted cost. So to reduce its cost, immediately stop all the flyers. Right. Imagine around 6 o'clock morning in the airports like Mumbai, Delhi, Chennai, where there's a heavy rush in each airlines because people are in a rush to go to another city for their work. All right. In such a situation, when there are no flyers, customers go to a certain queue, stand for roughly about 20-25 minutes because there's a heavy rush. Then at the end of the counter, they come to know when that turn comes that the counter is wrong. Now, this creates not only a sense of dissatisfaction, a lot of wrath, anger. So, it impacts the overall brand value of a particular company, airline company. Now, this aspect is not taken into account because the internal perspective to the output only, not these aspects of it. Cost of individual activities, group activities are usually not considered because the activity is not a focus. The focus is the cost incurred, expenses incurred, and the output coming out. Okay, how much resources you are consuming? That's all. You want to reduce consumption of resources? Remove the activities. Cost data is historical, mind you. The traditional cost management do not incorporate any consistent process of estimating future costs. Financial accounting doesn't. The moment you go into futuric financial accounting, they're all a part of management accounting. Hence, risk averse. Only when you go into the future, you will understand what are the alternatives available for you a decision. And when you choose a particular alternative, you have touched your risk. This is avoided. Overall goal of cost analysis is cost reduction. If cost is satisfied, you are getting back your cost. You're fine. You are a good businessman. That's not true. If you look into the Fortune 100 companies, 100 top companies of USA, in 2010 and 2019, just 9 years, you'll be shocked to know that at least, I'm putting the term at least, 30% of the companies have gone lower in their ranks. Or you might come across few companies which have left the business. They have shifted from one industry to another industry. What was the reason? Because many of such companies were engaged in a close-knit things and they were concentrating on cost reduction. Cost reduction is not the goal, is one of the goals. And that cost reduction forms a part of total business strategy. There cannot be a business which says that I'll incur any cost. But then there cannot be a business which focuses only on cost reduction. All right, cost reduction for what? So what is a business strategy? Now, this is a missing aspect in traditional costing system. Tangible inputs, very important, human capital, are not at all possible for you to analyze in the traditional cost systems. Because of these limitations, early 1990s, companies had begun noticing that their overheads component of their cost structure was displacing its direct labor expense components. These companies had minimal visibility to understand the behavior of these overheads. They didn't know why these overheads were occurring, what is the forces behind these overheads, what is the benefit of these overheads to the ultimate product and therefore their profit. There were no clue. They were only hunches. That's why we use overhead distribution was arbitrary and which were gaining in importance in money terms. The overheads were increasing it and the visibility was getting blurred and blurred and blurred. No clues were available for the reasons behind the occurrence of these overhead expenses. And therefore, allocation bases were arbitrarily chosen with no concern to cause-effect relationship. That means you cause an overhead incur, you do not know whether there is an effect, and if there is an effect, what is that effect? Product of services cost, therefore, did not reflect unique consumption of these overhead expenses. Let us say, for example, you keep a market analyst or a petroleum expert, scientist working in a petroleum company. Well, he is providing an excellent service. What resources is consuming? Resource consuming is nothing. Then why do you pay? This aspect needs to be focused in any business management. That it was a missing point in the traditional cost management was largely because competition was not that severe, technology was not shifting that fast, and the size of the markets was less. Consumers were less aware of their satisfactory level. Strategic cost management through tools like activity-based costing resolved this problem by focusing on individual work activity cost. Every individual activity was performed for a particular purpose, and that purpose must be a part of business strategy, and that business strategy decides the product to be sold, how much to be sold, and what is the profit to be earned. So the real point is those activities which are performed because of certain driving part of the strategy. And these costs were then traced to products or services through consciously chosen activity drivers. Why are you choosing this particular driver? The cause and effect relationship is visible, is made visible. So anytime you want to shift the cause and effect relationship, you make a change in the drivers. If there is no effect in terms of the strategy formulated, you remove them. A traditional cost management got redundant. The directly controlling cost gave way to managing the cost. Cost was no more considered as an headache, so that you need to control, you need to reduce. Cost is the process in the business entity. When you formulate business strategies, one of the processes that evolves is the cost. What is the cost process? It's a consumption of resources. Now, why do you consume resources? Because you want to create product or service to satisfy the customer. So, in order to satisfy the customer, you have to manage the consumption of these resources. That is the cost, which is compatible with the satisfaction level, the demand level of the customers. So this linkage with the cost and the value to the product or the service that you are giving to the customer, perceived by the customer, is the real crux of the modern cost management. For example, if a customer places an order daily and the vendor somehow persuades the customer to order twice a week in place of daily, right? The result would be that the vendor has reduced its order processing cost. Every time you receive an order, you have to process, and every time vendor has to give you supply an order, he processes that. He has reduced his cost by 4 by 6. Out of 6 days, he comes only 2 days now. So 4 by 6 days doesn't come. So the time he spends for processing the order reduced. It's possible on those 2 days his cost might increase. But if you see the overall, the 2/3 total cost has been reduced. This is managing the cost. And it's not accounting for cost. Accounting is just for the purpose of administrative reasons that you make accounts. For a data generation. The reality is that costs are abstract and intangible. In fact, one famous cost management guru said, expenses and costs are not one and the same thing, which is considered so in traditional cost management. Expenses are when the organization exchanges money with suppliers or the third parties for who has provided services like insurance, like travel, like telephone, like material purchase. In contrast, costs reflect the usage. Cost is not when you think, that is only an inventory. Costs reflect the usage of that spending. Right? If there is no usage, it is not a cost. It is a process of consumption of resources when an activity is performed. Cost is a process of consumption of resources when a particular activity is performed. So if the activity is useless, the consumption of resources becomes useless and therefore cost becomes useless. It's not the reverse. Because you have incurred the cost, you have consumed the resources and therefore activity has been performed. It's not that. So the cost management system should be like a radar system that reflects how the resources are consumed. This reflected image are analyzed for business strategy purposes, like any scientific imaging system does. And the crux of the entire paper is in these 4 or 5 lines, which I hope you will be giving attention to understand them thoroughly. Having briefly described to you that what could be the basic limitations of the traditional cost management, and then why this strategic cost management came. Any layman hearing me would ask me, how would you remove those limitations of traditional cost management? What are the tools that the strategic cost management uses to completely remove those things? One most important fundamental fact is the entire focus on the strategic cost management totally differs from the traditional costing. As I pointed out in the slide, the traditional cost management system is basically a mechanism of accounting, emerging from accounting. Whereas the strategic cost management, the modern cost management, is a management concept. It is not an accounting concept, it's a management concept. Why it's a managing concept? In the traditional cost accounting, the focus is the cost. What is a cost? When was it incurred? Why it was incurred? It was incurred for administration, it was incurred for production, it was incurred for direct materials, it was incurred for overheads. These are the questions. And who incurred it? Are you authorized? If you are not authorized, why did you incur it? Now, these are the stories of the traditional cost accounting system, which is answered by some of the tools that emerge from these questions, like prime cost, direct cost, overhead allocations, absorption of cost, etc., standard cost, etc. Modern cost management doesn't focus on cost alone. It tries to focus cost linked with value. Cost standalone concept doesn't exist in the modern cost management. Every cost has to be linked with a value to the customer. Cost is to be linked with the business strategy. This connect is the most important focal point in modern cost management, which differs totally, fundamentally from the traditional cost management. In addition to the inherent focus, that is, balancing the cost and value concepts, cost incurred or likely to be incurred and value to the customer. They both must be connected, both must be compatible. With this basic inertia, the tools have emerged over the years to handle different types of changes that are taking place in the business environment. They are, first and the foremost, the activity-based costing. This was the trigger point which clearly took away the cost management from the accounting area. It said no more accounting area. It is a management area. How do you manage the activities in the organization? Every activity has its own characteristics, has its own problems, and the management has to manage that. Having created the activity-based costing to give data about the activities performed, they are linked in a concept called value chain. Then how these activities need to be performed vis-a-vis the value of the customer, value to the customer of the output, came a target cost. The moment you take target costing, it's once again another very important step, going away from the traditional. The traditional cost accounting was internal located, focused. Okay, it was not knowing anything about the external. Whereas target costing brings the external perception, what is given in the business environment, to your internal management area. Right? What is the customer's perceived value, and therefore what is the price he is ready to pay, will be directing what is the cost that you can incur. That is what is the target cost. Third, once again going to the traditional cost management, there was no focus on the outside world, whereas quality could be understood, but quality is understood by the production manager. Quality is not understood in the traditional costing system as understood in the competition, as understood by the customer. What is the quality he is expecting, and what are the competitors giving them? So long the customer is buying my product, I am not bothered about the quality involved. This was the concept in the traditional costing system. So total quality management is a very important segment tool used in the modern strategic cost management. Benchmarking, very essential aspect of a strategic cost management. If you need to be competitive, if you need to have a competitive advantage, you need to keep compare yourself with the competitors, various aspects of your processes, not comparing with your final products, not comparing with your total profit, not comparing with your total cost, but comparing many of the activities that perform and try to come down to a holistic concept of benchmarked business environments. Business process reengineering. Change is a continuous. Change is unexpected. The way the technology is moving around, all right, the way the global economy is creating changes, various aspects. No business can stand still. It has to keep moving. And in order to keep moving in a positive direction, it needs to keep on re-engineering its processes. So business process re-engineering emerges as an important tool. JIT inventory control system, waste, eliminate waste. Zero defect was a concept, was a part of a modern strategic cost management, which brought out concepts like just-in-time inventory and management systems. A balanced scorecard, continuously evaluate yourself in terms of compatibility between cost and value. When I say cost and value must be compatible, it's not a given thing. Every time, because of changes external to the business, the compatibility may become incompatible. So you must keep on focusing on your strategy to see that are you doing well. So a measurement of that performance is a balanced scorecard. And the balanced scorecard might show you short-term problems in your processes, in your activities. So you must take a tactical decision to improve your processes to achieve the required scores. Kaizen costing, one of the very excellent tools in managing cost. Six Sigma, a standardized method of strategic cost management. Six Sigma is not a formula, it's a concept which we shall discuss. Life cycle costing, as I've already told you, we are no more concerned with costing in accounting concept. We are managing cost. So when we are managing costs today, we take into consideration what would be the impact to the customer in terms of additional cost in the future. So we like to see the cost of a product throughout its life cycle, not confined only to the production and the point of sale. Theory of constraints. We recognize the limitations in a modern business world. What are those limitations? How it impacts my strategy, and therefore how it impacts my cost value compatibility is a theory of cost. When I capsule all these tools into my total strategic management principles, I get what is known as activity based management, or you can say activity based cost management. Students, we continue with our limitations of traditional cost management topic. We saw in our discussion in the last slide how the traditional cost accounting system do not take into account the actual activities that are performed within an organization. Because of not focusing on the activities, companies tend to neglect the connect between those activities and the business strategies. By not taking into account the business strategies, the cost incurred may not be necessarily in conformity with the expectation within those business strategies. Since cost accounting system focuses on the expenses incurred in relation to the output, it connects all the expenses incurred to the output coming, and in case there are 10 to 15% of the expenses not to be covered, it keeps them aside as expenses not within cost accounting. Nevertheless, it takes into account some 85% of the expenses as necessarily related to the products, which subsumes the waste part of those expenses. Take a classic example of standard costing. Let us assume that a particular activity consumes 10 kilograms of a material. Now, this is fixed as a standard. If you consume more than 10 kilograms of that material, then you find out the reasons for variance. The product purchase is of poor quality, product handling was wrong, etc., and try to tend to be 10 kilograms. And if it is below the 10 kilograms, you're quite satisfied and happy that you are able to make some unexpected savings. But this doesn't take into account the process of activity that goes on. In a layman's language, when a particular worker engages in performing a particular activity, he is trained to gain some experience, or more so, by putting some additional skill into his ability, there is a possibility of his performing that activity more in an efficient manner. Or take an extreme example that the technology has shifted so much that the particular activity the worker is performing has become redundant. In all these cases, the traditional cost accounting continue to record the accounts and the expenses incurred as a cost and charge to the products. Take the case of duplicating machines in many of the offices. Duplicating machine is a machine which is used to take copies of the original printouts so that you can distribute them physically, that paper, to large number of people, users. But in today's changed world, of digital communication, you have emails. You don't have to wait for printouts to come and copies to be distributed physically. Within a split of a second, hundreds of thousands and millions of people can get the same message in their hands. Now, this aspect makes the xeroxing of copies, papers, redundant. Now, these are not well addressed in the traditional accounting system unless someone recognizes this as an activity which is no more useful and therefore removes it. That is possible only when the business management, the business strategy is directly linked to the cost being incurred, the activity being performed. So, one of the most important triggers that facilitated in understanding the limitations of a traditional costing system was the emergence of these activity-based costing concepts. Through the routine inspection of various activities in the production flow, production managers found that traditional costing is not enabling them to make a difference in their decision making, and at many points of time they could not appreciate the changes that are in activities that are being made or the impact of a particular activity, that is the consumption of resources by those activity on the final product. This brought about a revolutionary change in evolving a concept known as activity-based costing. Since this tool, the activity-based costing, forms one of the most important reasons for the emergence of modern strategy cost management. This, as a tool which enabled the recognition of compatibility between the cost and the value to the customer as the hub important points in any cost management, I thought that I should explain to you this tool in detail so that when we take up other topics, you understand those topics, nuances through the activity-based costing. I'm sure many of you might have heard this word activity-based costing. But unfortunately, an impression is created to many students that activity-based costing came about to improve the overhead allocation apportionment systems. That is not true. Activity-based costing might have come among many other factors as the impact of the overhead allocation system on the costing mechanism. Overhead allocation system's limitation was recognized. But having recognized, when alternatives were sought for, one of the glaring points that emerged that cost has no relevance to the accounting system. Cost is actually the process of consuming resources. So the moment you take cost as the point of consuming resources, it is a process. You take away the accounting aspect, you see something happening, a phenomena, and you have to manage that phenomena. The consumption of resources process is to be managed. Managed can be increased, can be improved upon, to be better improved, and how to combine with the technology, etc. and all. It is here the focus came to activities. So therefore, activity-based costing is a natural outgrowth of today's competitive and complex environment. We shall discuss about the complex environment sometime later in some slides. The complexity is pushing the traditional cost accounting totally out of any meaningful discussions. This complexity of an environment in terms of technology, in terms of factual competitions, in terms of unexpected innovations coming about, substitutes coming about, all these complexities because of variant customers' behavior customers' awareness of competition, all these complexities have resulted in thinking afresh about the relationship between what you want to deliver to the customer and how you have to deliver it, what activities you are going to perform. Activity-based costing provides a closer approximation of the cost of a product than the provided by the traditional volume-based costing methods. The main principle of ABC states that activities cause costs and to control costs. Alright, so it is activities which cause costs. It is not because cost you have incurred, therefore you have performed that activities. No. Because you have committed salaries to the labor and therefore labor is working for you is a myth. The real fact is that you have to pay him salaries because he has performed a particular work. That is the contractual understanding. And therefore, when you are controlling cost, you are not controlling the cost rupees. You are controlling actually the process, the very activities. Activities must be controlled. Under the activity-based costing system, the activities are identified, which is the point where the resources are consumed. Okay. Now, the expenses related to each activity are clubbed together to get an activity-wise expense, which means, a particular activity is done by 10 people, you can club them and call them under one category. If they are continuously done for, say, different products, you can club them and call them, say, order processing activity. All right. Now, when you receive an order, what are all the activities you do? It can be 1, 2, 3, but all related to order processing. But if you want to focus only on order processing aspect of a management, then you go deeper. Which of those activities of order processing can be separated? Separate them. Focus them. So, in fact, an activity-based costing permits you to develop a modular system of costing. So, you've got to understand this hierarchy of activities. Now, what is that activities would mean? An organization is nothing but cumulative aspect of activities performed. Every organization performs certain activities. It could be performed by the top management, it could be performed in financial, it could be movement of cash, movement of goods, selling of goods outside, anything. So activity would mean where man and machine combine separately, perform certain activities which is based on the business objectives of the organization in which that activity is performed. And all these activities have a common link, that they are of a one single business and therefore they have to be linked. There is no activity which can be seen separately. There must be a linkage. Quite true. To identify that linkage may be difficult, but they are linked. This presumption is a maxim. And every activity will be performed because of certain rationality, certain cause, certain reason. So if I say movement of material, so the movement of material is because you want to store them, or you want to take the material to the production floor, or you want to throw the material outside your organization as a waste. Now, all these things have a particular purpose. So, every activity has a purpose. Cumulatively, all activities have a business purpose. Now, once you understand this, come to the actual activity being performed. When a particular activity is being performed, there is some consumption of resources. Right? There is an activity which does not consume resources, not possible. The very activity is an economic sense, must be consuming certain resources. And if there is an activity performed which does not consume any resources of any type, then it's very interesting to identify them and see what is its benefit in terms of its value to the customers. So there is a justification for performing that activity. So the driver, the cause for which you are performing that activity, becomes the driver of that activity. Now, the driver of the activity to be given a meaningful form is given as the cost of performing that activity. And so, therefore, the driver for that activity becomes the driver for the cost, named as a cost driver. Now, these are very fundamentals. But if you understand these fundamentals, you will be able to understand various topics. And when you go to the real field, you will be able to understand this activity-based costing through that various tools like target costing, Kaizen costing, life cycle costing in much simpler way. And when you solve problems in your examinations, you'll be able to solve them much quicker. Right. Though I'm sure you will not be asked a very deep-rooted problems where you have to identify activities or cost tables, etc. They all will be given, but have a good understanding of activity-based costing will go a long way in your professional career in putting cost management as an important base of your profession. Let us take an example. I want to place this limitation through an example so that it gets grained. I brought these lecture slides mainly to bring out the emphasis of ABC costing in the strategic cost management as understood, practiced in the contemporary world. Let's say, for example, company XYZ has two fixed price contracts to two different clients. A normal understanding of fixed price contracts, the amount is fixed, two different contracts. What do? They manufacture components. The company has enough capacity for both contracts, but is uncertain whether they will be profitable. They're not very sure. Look at how this strategy operates. It's not merely because two clients are there, you calculate cost, find out the profit. No. We are talking in a much comprehensive sense, as that though they can supply to both of them, there is a capacity, but they're not sure whether they are profitable. Because the price, the contract price, that is fixed. The details are, let us say, two components, AAA, AAA, and AAA. And that component type name is A999, B999. Contract value is fixed, 27,000 is 1 lakh. Now the question is whether 27,000 will give you profit, whether 1 lakh will give you profit. That's the dilemma that the management is facing. Contract quantity for AAA is 1,000 units of components in 999. Whereas for a contract value of 2 lakhs, the amount is 2,000 units. Do not think that both are similar because contract values, right? Apparently, there must be some special features in component B999 which is not existing in A999. What is the material cost? Material required for AAA is 15 rupees per unit. Alright. Per unit, you need material worth 15 rupees. And in case of BBB, you require 20 rupees per unit. But they are manufactured in batches. 1,000 units, you cannot do one by one, you make a batch. So each batch takes 5 hours. And each batch consists of 100 units in case of AAA. Whereas in case of BBB, each batch takes 7.5 hours. And each batch consists of 50 units. You can easily calculate the number of units and all this. So that basic working we have done. But before that, it presents you the annual measures of the well-known overheads given to you from the financial accounts, molding activity. Right? The activity is molding, mind you. If you understand the word molding, why it is molding? Molding hours, cost driver. Right? You require so much of molding hours. When you manufacture a component, how much time it takes to mold a particular component? So that decision, that what is the mold and what is the type of steel, that drives the activity for so much time. So you understand the basics of hours. So 2,000 hours is the total molding budgeted. And for doing that, the total expenses, consumption of resources is 1,50,000. Which you can roughly understand. We will show it in calculation also. Which it would mean, in particular with regard to this molding activity, you incur per year 1,50,000 rupees by operating for 2000 hours. All right. Inspection. You inspect for quality purpose, for counting purposes. 150 batches. Total 150 batches you can do it. On which 75,000 hours. Batches could be AAA or triple A. Per batch is the amount. Production management contracts, the real management process, 20 numbers. You can contract for 20 numbers and giving that contract becomes 1,25,000. Remember, we are talking only 2 contracts out of 20. Calculate the activity-based cost and profits for each contract and calculate the profit for each job using absorption costing. That's a traditional cost. And absorb overhead using molding hours. The moment you talk of traditional costing, you're going to talk of what is overhead base. Whereas in case of activity-based costing, you have to talk about activities and each activity shall have a distinct cost driver. All right. So this distinction is visible in the question set up before you itself. First, we have to calculate the activity-based cost. Let us take, for example, the basic computation of basic information before we start going for AAA and BBA. Molding activities, total cost is 1,50,000. 2,000 is a cost driver, hours. So 75 rupees per molding hour is the driver cost as per the budgeted information given to us. Inspection total cost is 75,000. Total cost drivers is 150. Remember, cost driver for molding is 2,000 hours. Whereas in case of inspection is 150 batches. The entire unit changes. This is the classic meaning in activity-based costing. Overheads, it's same. Hours, molding hours is irrespective. Inspection, molding, product management, nothing. It is one overhead absorption rate, that is molding hours. Whereas in this case, molding, it talks about the cost driver, different for molding, different for inspection, different for production management. So in production management, total cost is 1,25,000, budgeted for 20 contracts. So it becomes 6,250 rupees per contract. So calculating the cost per driver is essential because once you start product costing, you have to find out how much of drivers are required for that particular thing. Let us say there are 2 products, customer AAA, customer BBA. How many batches are there in customer AAA? 1,000 batches. And units are 100, there will be 10 batches. 1,000 units divided by 100 units per batch, that is given to you. You see, it's given 1,000 units and 100 units batch size. So therefore, if it is 100 units batch size, you get 10 batches. Whereas for BBB, 2,000 units, 50 units per batch, so therefore 40 batch. Look at the very distribution goes logically. Molding hours, 10 batches gives you at the rate of 5 hours giving, per batch is 5 hours given to you, for 10 batches 50 hours. So AAA takes total 50 hours, whereas customer B takes 300 hours. 40 batches, the number of batches is less or more, and the hours taken is also more, 7.5, it becomes 300 hours. Contracts both are 1, so immaterial. Let us try to calculate the profits. Selling price is 27,000 for AAA. 1,000 units at the rate of 15 rupees per material cost per unit comes to 15,000 rupees. This is direct, no confusion. Molding cost, there are 50 hours AAA takes. At the rate of 75 rupees is the cost driver per molding hour. So it becomes 3,750. 10 batches, inspection cost. There are 10 batches. Each batch costs you 500 rupees. That is calculated. We have calculated already 500 rupees per batch. Clearly we have calculated. So that we are applying it. multiply by 10 becomes 5,000. The total cost is 6,250 for 3 different activities. So it is converted into a total cost of 30,000, and yet there is a loss of 3,000 because selling price being 27,000. Now look at the absorption cost. Compare for A, which I have given you under the title B below the table. Cost for AAA is rupees 15,000. Material cost will remain same. 50 hours the molding hours multiplied by 175 rupees per hour. See, total hours divided by the total cost, 175 rupees per hour becomes 23,750. So you get a profit. As per absorption costing, look at the mistake. Look at the directional mistake that is done. Absorption costing shows you that AAA makes a profit of 3,250. So what you will do? You will take more such contracts. The customer AAA will give you more such contracts. And every time you are making the contract, you are actually incurring a loss of 3,000 rupees. Let's go to B. Total sales price is INR 1 lakh rupees, 2,000 units. Right. Now, how did they arrive at 40,000 rupees, 2,000 units at the rate of 20 rupees is the material cost given to you, direct cost, 40,000. Molding hours are 300 hours at the rate of 75 rupees per hour. So it comes to 22,500. 40 batches are there at the rate of 500 rupees per batch becomes 20,000. You get total 6,250 is the management cost. What cost same? One contract. So total cost comes to 88,750 and you make a profit of 11,250. Look at the BBB and the absorption cost. 40,000 material cost remains same. Overheads are to be distributed on the basis of hours, so 300 hours. Absorption cost is same, whether it is AAA or BBB, 175 rupees, irrespective of the batch, inspection. Look at it is not only molding, it takes into account inspection, production cost, contract cost, everything is same, all distributed on the basis of a single principle of molding hours, therefore which comes to 175 per hour, comes to total 92,500. It makes a meager profit of 7,750. So, despite the fact that the sale price 1 lakh and the profit should have been 11,250, you absorption costing has been showing only 7,750. This is likely to lead the company to a wrong management decisions, wrong product mix, and therefore diluting its profit to a great extent. This is a comparison between the traditional costing system and showing the limitations of the traditional costing system and the modern costing systems. So activity-based cost allocation system, which we saw, is a complexity in modern firms it recognizes. What type of complexity? In a modern multi-product firm, it is recognized that costs are incurred by undertaking activities. What type of activities are such? Setting up of a machine. You saw in the batches, AAA had 100 units per batch, whereas BBB has 50 units. So therefore, you are going to configure the machines accordingly. Scheduling the production, whether AAA will go or BBB will go, you have to schedule the production. This is a very important activities. Ordering the raw material, because A requires maybe a different raw material, which is costing 50 rupees per unit. There is another cost you 200. So ordering the raw material is a process. Finding a new vendor, such cost. 20 contracts are there. You are not talking only 2 contracts, but you are going to find out new contracts. So searching cost, developing a new products, marketing research should be there continuously. These are the complexities that exist in firm, which is not addressed by the overhead absorption system, which we saw in the example. Making a quality inspection. Inspection may be only counting, but quality inspection. So how do you ensure quality inspection would require you to define quality management. All right. These costs are more related to factors other than output and volume. Examples of non-volume factors, drive cost, how many parts and products of the company handles, how many parts, and how many customer ordered it processes. All right. This is nothing to do with volume. These are factors that affect the complexity of the modern company. I mean, the complexity in the sense of management decisions involves a lot of details to come to a decision which is supposed to be optimal. Complexity exists in various forms. The range of products. No more a company can talk of only one product. Maruti would have been a loss-making company if it decided only to have only one Maruti 80. Look at the range of products it has brought out so that it became a successful company. So is Reliance, right? So is, for that matter, Airtel. The number of customers, markets, and distribution channels. With the global, you can understand the complexity involved. The frequency of product introductions. Some new product from China, from Finland, because it's low cost, it gives you better usage. So the product introductions are continuously. The variants available for each product, substitutions available. So therefore, your competition is always loose. Customization. The frequency of changeovers in the production processes, setup, technology is changing, right? So these are the complexities that makes costing quite simple. Response to challenge the complexity. Can traditional costing system cope with this complexity? No. As we have correctly been emphasizing through that example, it doesn't seem to have that capacity, mainly because the traditional costing system focuses only on the accounting aspect of cost, which is the final products. As we saw, many of these complexities do not have any link with that final product. It's a business environment in which you have to manufacture the product. Now, if you talk only of the product and you forget about the business environment, you lose the connect properly. Various methods have been tried by companies. Examples: creation of more base, cost centers. These are all overall absorption. We know the history of cost accounting systems. Using different percentage rates to vary cost burdens to counter cost distortions. Purchases from subcontractors charge 15%, whilst all other purchases are 10%. Now, this is a complexity. So, how do you handle this type of a situation unless you make purchases activities separate? Fundamentally, all these methods ultimately use output volume allocations. As we saw in case of the example, the molding hours was used as absorption volume. Thus, they never reflect the true cause and effect of cost in modern times. Cause and effect on the value. Modern cost management system not only talked about the cost drivers, but its effect in the customer's perception of value, satisfaction. So this is missing in tradition. Thus, the need arises to re-engineer the cost continuously, cost analysis and control system to deal with these complexity costs. Significant changes in business environment. At the end of the 20th century and the beginning of 21st century enabled the development and application of modern cost accounting methods, which whose main purpose is to give required information to management regarding the effectiveness of certain products, the projects, activities, consumers, responsibility centers, etc. Why information to management? So as to link the business strategy with the cost strategy, which is totally missing in the traditional cost accounting. Traditional cost accounting methods were developed in the middle of 20th century due to the automation of production. Right? So they thought overheads was emerging, so they found a method of costing. The focus of traditional cost accounting methods was on manufacturing cost. Whereas today, for example, in India, 60% of the GDP is given by service sectors, service industry. Manufacturing is only 25, going to roughly about 16 or 15 to agriculture. So the direct manufacturing cost allocation to products or services was the focal point. But further development of technology, changes in consumers' preferences, the most important, glaring revolutionary change. Global competition faced modern manufacturing companies with permanent challenges of survival at the global markets. Traditional cost accounting methods are no longer appropriate in modern business conditions because cost accounting methods indicate the potential areas in companies where are possible cost savings. Therefore, modern cost accounting methods are focused on cost rationalization, whether you require to incur the cost, and cost reduction, therefore the cost reduction. Since modern manufacturing companies cannot affect on modern market prices, it is a global market. You are not in a seller's market. You are in a competitive market where uncertainty is looming large. So what you can affect is your cost. In current business conditions, modern cost accounting methods are more appropriate while they are focused on the total cost through the whole product life cycle. This paper in final CA examination deals with the modern cost management methods and their application in companies. Thank you very much.
Thanks for watching. Do not forget to click the subscribe button and hit the bell icon. Do like, comment and share. See you next time. Subscribe and hit the bell icon.